Greg, I want to start with you as we see this rebound in oil prices. Are we seeing it driven because of the dollar, or are there other things that are playing into it?
Well, the big news last week was that Saudi Arabia is discounting prices to Asia, so there's some competition among OPEC members. And then they're saying they're not going to cut production until the November 27th meeting, and that's not even guaranteed. So we're seeing pressure on prices, and we're seeing the oil VIX, or options volatility, spiking because there's some uncertainty in the market.
And Phil, what are you seeing here in the market as well? I mean, with OPEC sort of, as Greg pointed out, saying it's not going to come in and act right now, I mean, how long can this rebound really last?
Well, I think it's just going to be a small recovery this week. I think that we did have that washout last week to that 17-month low. I look for prices to move back up to that $92 level. I mean, remember, look at the supply and demand. Currently, right now, our production levels are 8.8 million barrels a day. We're at a 28-year high. Our imports are at an 18-year low. We're only importing about 7 million barrels. So we're building a lot of inventory. Inventories right now are above the 5-year moving average. So I'd expect crude oil prices to continue to weigh in under pressure for basically the remainder of the year.
And so how are you trading that? Because it sounds like you do think we'll see a little bit of a rebound here before push back lower.
Yeah, I would expect crude oil prices to move back up to about the $92 level. I would look to short the contract right there with a stop loss up at 95, so we're risking about $3,000. I anticipate crude oil prices will retest last week's low, and actually if they break through that, I think they're going to trigger a lot of stop losses, and we're going to see a quick plunge down to $86.
Gotcha. So to put Phil's trade in layman terms for everybody, he's expecting oil, as he talked about, to recover this week. He'd be selling it when it reaches 92 with a stop at 95. So he's risking $3, but remember, oil trades in contracts of 1,000 barrels, so he's really risking $3,000. And since he thinks oil is heading back down to $86, his potential profit on this trade is $6,000. Greg, just very quickly here, do you agree with Phil that we could see a little bit of a move up and then perhaps more pressure on oil prices?
Yeah, traders are looking at a potentially good risk-reward scenario here. You have a market that's oversold technically. You have a spike in options volatility that I mentioned before that shows you some fearful sentiment. So traditionally when traders want to come in, fade the move, buy the contract with a defined risk. But I also agree with Phil, if we get up back above $95 or $95 range, you're going to see some sellers coming into this market.
I want to get to our word of the week here, and this is one that you tend to hear not in necessarily the oil world. You hear it in another word, that's scalping, which I think of as something you do with tickets.
Yeah.
But how does it apply to futures trading?
Well, it's a trading style where you take a small amount of risk for a small amount of gain. And historically, it was very popular among floor traders. But now all the volume is going to the screen. So the scalpers of today are making very heavy technology investments to get super fast data and super fast execution speeds to get in and out of the markets very quickly.
Interesting. Small risk, small reward.
Yep.
Thanks so much, Greg. Appreciate it. And thanks to Phil Streible as well. Appreciate it.